Financial Accounting Chapter 9. Preamble: a tale of two companies. It was the most easygoing and the busiest of times when it comes to computing transactional tax rates, preparing and remitting returns, and keeping exemption certificates, which sounds more like your company. Whether an accounting and finance staff is grinding away at tax compliance the old way, or is armed with automation and the necessary software to do the work, sales and use tax compliance looks very different. At some companies, the run-up to deadlines might mean a jumble of extra work hours and rushed calculations, while at others, deadlines are handled smoothly and without unnecessary haste. Some finance and accounting teams are terrified of audits, but others see them as a necessary part of running business and are certain that their numbers will add up. Introduction. The terms tangible and intangible assets refer to two different sorts of assets. Physical assets, or property owned by a corporation, such as computer equipment, are examples of tangible assets. Tangible assets are the most common sort of assets used by businesses to create their goods and services. Although intangible assets are not tangible, they have a monetary worth since they represent potential revenue. Copyright to a song is an example of an intangible asset. Every time the music is played, the record label that owns the copyright receives a royalty. The recognition of assets. For an asset to be recognized in the financial statements, it must the following definition laid down in the IASB framework. The asset is a resource controlled by the entity due to past events and from which future economic benefits are expected to flow to the entity. IASB framework. Should leased assets be recognized? Leases prescribe the accounting policies and disclosures applicable to leases, both for lessees and lessors. Leases are required to be classified as either finance leases, which transfer substantially all the risks and rewards of ownership and give rise to asset and liability recognition by the lessee, and a receivable by the lessor, and operating leases, which result in expense recognition by the lessee, with the asset remaining recognized by the lessor. Depreciation of a cost. The value of a fixed asset less all of the depreciation that has been recorded against it is called depreciated cost. The depreciated cost, in a larger economic sense, is the total amount of capital used up in a certain period, such as a fiscal year. The depreciated cost can be used to look for patterns in a company's capital investment and how aggressive its accounting techniques are, as measured by how precisely depreciation is calculated. The salvage value, net book value, or adjusted cost base are all terms for depreciated cost. Impairment. Impairment is a term used in accounting to denote a permanent decrease in the value of a company's asset, which is usually a fixed asset or an intangible asset. When evaluating an asset for impairment, the overall profit, cash flow, or other benefit expected from that asset is compared to its present book value on a regular basis. If it is determined that the asset is book value exceeds the future cash flow or benefit of the asset, the difference between the two is written off, and the value of the asset declines on the company's balance sheet. Measurement based on revaluation. Entities can select between two PPE valuation models under IAS 16, the cost model or the revaluation model. Each model must be applied uniformly to all PPE belonging to the same class. A class of assets is a grouping of assets in the business that have a similar nature or function. Property, for example, is one type of asset, while plant and equipment is another. Furthermore, if the revaluation model is used, the revaluations must be kept current, despite the fact that IAS 16 does not specify how often assets must be revalued. Assets are carried at their fair value when the revaluation model is employed, which is defined as the amount for which an asset may be traded between competent, willing parties in an arm's length transaction. Investment properties. IAS 40, International Accounting Standards. The term investment property refers to property, land or buildings kept for the purpose of earning rent or capital appreciation, or both. With a few exceptions, investment properties are initially valued at cost. It may be subsequently measured using a cost or fair value model, with changes in the fair value under the fair value model being recognized in profit or loss.